Hi, good morning, everyone, and welcome. We are so happy to have you here with our session today. It's actually our first webinar of the year, and it's focused on a topic that so many of you is relevant to. So we're talking about taxation for G4 visa holders. And this is session 1 today, and then tomorrow we're going to have another webinar on taxation for U.S. citizens and green card holders. So we're making sure that we're expanding across the board so that everybody is covered for a very important topic that affects every single one of us every year, taxes. Our panelists today are Dale Mason. He's the CPA and founder of Dale Mason and Corporation. And then we also have Jose Sobrado. He is CFA and president and founder of MG Capital Partners, LLC. On your dashboard today, you're going to find a couple of changes and enhancements that we're super proud of. You can access the chat and ask a question feature to submit your questions anytime during the session. We usually leave some time at the end, a good amount of time, because there's always some great questions to answer those. Additionally, you can learn more about our panelists. There's going to be a great little bio there under the speakers section. And then we encourage you to take a moment at the end to complete our survey. Your feedback is super important to us, and it helps us shape future events. And then you can also explore our latest loan promotion in the console. So I know it's a little bit of marketing and promotion, but we do have amazing rates out there. So either if you have a loan currently and you want to refinance, or you're looking for an auto loan, we really are competitive in the marketplace. And feel free to use the emoji reactions to engage with us throughout the event. We want to hear from you. We love the claps, we love the thumbs up, the thumb down, and the celebration. And we want to make sure these interactions are so valuable to you. Closed captioning is enabled. You can enable it on the media player streaming our cameras. If you'd like to activate them, please click the small CC button in the player controls. This session is recorded, so you will receive an email with the recording of the session afterwards. So without much further ado, I'm going to welcome our speakers to the stage so they can get to the most important information. Welcome.
Thank you, Marilyn. Thank you for that lovely introduction. Hello, everybody. Dale and I are very excited to be here. Looking forward to a great session full of information and questions. We really love your questions. As Marilyn said, please take time as we go through the presentation to write your questions. We have to answer them in the order that we get them. So the sooner you get your question in, probably a better chance that we can get to it. We have action and content-packed presentation today. This session is for G4 visa holders. As you are probably getting tired of winter, spring comes along with taxes. So hopefully this will help you think about your obligations for this upcoming tax season. But not only that, also we want to help you think more generally about long-term issues, financial planning issues related to taxes that can help you as well. Unfortunately, I have to start with a brief disclaimer. There's only so much time we have today, and United States tax law is very, very complicated. It's not an understatement to say that the US tax law is the most complex in the world. So unfortunately, there's going to be many exceptions to the rules that we will discuss today. Please do not interpret any of this as personal advice. Consult with tax, financial, investment, or legal experts when making decisions that affect you personally. Here's our agenda for today. We want to cover general aspects of taxation and tax residency. We want to make sure you understand the meaning of tax residency and how that affects your tax status vis-a-vis the US. We also want to help you understand some of your obligations and requirements when it comes to filing. And we want to help you think about some of the financial planning implications of the tax rules that we will discuss today, particularly when it comes to your investments and when it comes to real estate, whether it's the sale of your home or a property that you might rent. And we also want to spend a little bit of time helping you avoid some of the most common tax return errors that we see in practice so that you do not make the same mistakes. Let me start with taxation in general. And the best place to start is, of course, helping you understand what it means to be a tax resident versus a non-resident of the US for tax purposes. Tax residency is the most important consideration when it comes to understanding your obligations. Why is that? If you are considered a U.S. tax resident, you are subject to taxes on your worldwide income. If you're a green card holder or a U.S. citizen and you're considered a tax resident, you have to declare your income on a worldwide basis to the U.S. No matter where that income happens, no matter where those earnings occurred, they are subject to reporting and taxation in the U.S. Double taxation in that case is a big concern, and you have to understand how to avoid double taxation. However, if you're a non-resident for tax purposes, then things are very different. You're only responsible for taxes to the U.S. on certain types of income, specifically income considered U.S. source income for tax purposes. So tax residency is very important in beginning to understand your tax obligations. If you are physically residing in the U.S., if your legal home is in the U.S., then you may become a tax resident based on the days of presence in the U.S. Depending on the amount of time you spend in the U.S., that the days of presence could mean that you become a tax resident. However, those days of presence are not counted, are not considered for the purposes of tax residency if you are a full-time employee of an international organization. The substantial presence test does not apply for you if your presence in the U.S. is due to full-time employment with an international organization. That is the reason why most of you here today, most G4 visa holders, are non-residents of the U.S. And the same is true for your dependent spouses and unmarried dependent children under the age of 21. The same is true for them. They are dependent on your status. As long as you are a non-resident, those dependents will also be a non-resident. Now, that wouldn't change for your spouse, for example, if him or her was employed and worked in the U.S. Having U.S. employment under a G4 dependent employment authorization does not make you a tax resident. It means that perhaps those wages, that income is subject to taxes, but you're still considered a non-resident for tax purposes, and that is very important. So how does one become a tax resident? Of course, if you had a green card, the green card test of tax residency. If you had a green card, you would be a tax resident of the U.S. beginning from the first day in which you have a valid green card. So if you retire from the IDB and stay here, apply for your green card, that is one day in which you will become a tax resident, the first day with a valid green card. But in addition to that, you could also be a tax resident, as I said before, based on your presence in the U.S. The substantial presence test is another way in which you can become a tax resident. If you spend more than 183 days, then you would become a tax resident as well. Now, it's not only the days of presence in the current calendar year that count. The formula is a little bit more complicated than that. You have to go back 3 years and count 100% of the days in the current year, 1/3 of the days in the previous year, and 1/6 of the days in the year before that. If the total from that formula is 183 days or more, then you become a tax resident, provided that you spend at least 31 days in the current calendar year. You must spend at least 31 days in the current calendar year, otherwise the formula does not apply. So one can become a tax resident under either one of these tests or under both. If you meet the requirements for both tests, then of course you will be a tax resident from the earlier of the two. And then there is the possibility of electing to be a tax resident. That may be relevant for many of you G4 visa holders if you are married to a US person. Anybody who is a non-resident but is married to a US person, whether it's a US citizen or a green card holder, anybody that meets that requirement can elect to be a tax resident, regardless of your visa, regardless of your substantial presence test, conditions. If you are married to a U.S. citizen or a green card holder, you can choose to be treated as a tax resident of the U.S. This is the so-called 6013G election. Why would a non-resident, a G4 visa holder, for example, want to be treated as a tax resident? Well, making this election, if your only source of income are your wages from the IDB, making this election does not have a tax impact for you. Your wages from the IDB are still not subject to taxes, even if you make this election. So it might not mean that you pay more taxes as a G4 visa holder, but it could mean that your spouse saves a lot of money in taxes. By making this election, your spouse can file jointly with you. And filing jointly generally means lower tax obligations than when filing separately. A person filing separately has a much smaller standard deduction and higher marginal tax rates than a person filing jointly. So in many cases, a G4 electing to file jointly with a U.S. citizen or green card holder spouse means that the couple would pay less taxes overall. But that's not always the case. That might not be the case if the G4 has income outside of the U.S., investments, rental, property, other income outside of the U.S. that wouldn't be taxed normally to a non-resident becomes taxable if you elect to be a tax resident. So the election is different for everybody. And very importantly, the election can be revoked, but it can only be revoked once. So if you make it and revoke it, you cannot make it again in the future. So this election may be advantageous for many of you, but requires some thinking, not just about your current tax liabilities, but also about how your situation may evolve in the future. Now, if you're a non-resident, which most of you will remain, regardless of your days of presence or anything else, as long as you're full-time employed for the IDB, you will, under the G4 visa, you'll remain a non-resident. Then your taxes will be determined based on whether you are being taxed on income that is effectively connected or non-effectively connected. Effectively connected means effectively connected to a U.S. trade or business. That would mean things like employment for a G4 dependent, wages or self-employment income for a G4 dependent. It could also be, for example, rental income from a U.S. property that you rent. These types of income are considered effectively connected income. And those are taxed at progressive tax rates. The more you earn, the more income that is taxable, the higher your tax rate. Rates are currently ranging from 10 to up to 37%. And some deductions are allowed. We will talk more about that. Not many, but some deductions are allowed for non-residents. Non-effectively connected income, on the other hand, is income that is not connected to a U.S. trade or business. And that's basically investment income. That type of income, when taxed, only U.S. source income is taxed in that case. But when taxed, it is taxed at a flat rate, 30% tax rate, regardless of how much income is involved, and no deductions will be allowed. Talking a little bit more about effectively connected income, we said that would cover wages, that would cover G4 dependent wages. So if your G4 dependent has an employment authorization and works in the U.S., then those wages or that self-employment income is considered effectively connected income. Some deductions are available, but very limited. Basically, generally, you're just allowed to deduct state income taxes that you pay locally to your state, and perhaps charitable contributions that you make to charities, only if those charities are U.S. qualified, are considered U.S. qualified charities. Currently, the deduction allowed for state income taxes is capped at $20,000. So you may be able to deduct up to that amount if you are subject to taxes locally at the state level. Otherwise, there's not much else that you can deduct. And as we said before, your wages as a primary G4 visa holder from an international organization are not subject to taxes. So with that said, let's talk a little bit more about taxation of things like investments and real estate. I will cover investments, and then Dale will join us to cover real estate. We are talking now about non-effectively connected income. As I said, generally taxed at 30%. That is the tax rate applicable to non-effectively connected income earned by non-residents, unless those individuals are covered by a tax treaty that could allow for a lower tax rate. Now, I mention that because that generally won't apply to you. As a full-time employee of an international organization living here in the US, you're probably not a tax resident anywhere else in the world. You're probably a non-resident everywhere. So in that case, your tax rate is going to be 30%. Not every type of investment income will be subject to taxes. Interest income, for example, is always non-taxable to non-residents, and that can be many things. You can earn interest from your deposits at the bank, or investments like treasury bonds or any other type of fixed income securities, any other type of bonds. All of that earned interest that you can earn as a non-resident will be non-taxable here in the US. And of course, if you're not a resident somewhere else, like most of you are, then it's completely tax-free, right? Most G4 visa holders who have investments in the US are not paying taxes on interest earnings anywhere in the world. Dividends could be a little bit different. If you own stocks, company stocks from different companies, then dividends would be taxed based on the source. If you own shares of US corporations, then those dividends are considered US source and taxable here in the US. On the other hand, if your shares are from foreign companies, then those dividends are considered international and not subject to US taxes. They may be subject to taxes in other jurisdictions, but not here in the US. So you don't pay the 30% tax on foreign source dividends. A very important consideration for many of you with investment portfolios, in addition to interest and dividends, of course, will be capital gains. If you buy an investment today and you sell it in the future for a higher price than you paid, you will realize a capital gain. Generally speaking, capital gains are non-taxable to non-residents. But unfortunately, there's a rule in the US tax code that affects most G4s, and that is that capital gains, which are normally non-taxable, become taxable if you spend more than 183 days physically in the US. This is different from the substantial presence test for tax residency. You will still be a non-resident in the broader sense, but when it comes to capital gains, your capital gains will be taxable here in the US at the same flat rate, 30%. And it doesn't matter whether your capital gains are realized in the US or outside of the US. And this is something that catches many G4 visa holders by surprise. Perhaps you came here to work for the IDB, but you kept investments back home. Generally speaking, any interest dividends that are generated from your investments back home are not relevant for US tax purposes if you're a non-resident. Capital gains, the moment you spend more than 183 days here in the US, capital gains become taxable, even if they're realized from your investments back home. Perhaps you have a brokerage account back home, you've owned investments for a couple of years, and you decide to sell them. You have a capital gain that is taxable here in the US if you have spent more than 183 days in the country. And it is possible that you pay taxes back home on that transaction. Capital gains may be taxable back home. Unfortunately, that exposes you to double taxation. That doesn't mean you don't owe taxes here as well. And because you're a non-resident everywhere, it means that effectively you could be double taxed when that happens. So something very important to consider when maintaining investments outside of the US if you are now living here. A very important part of complying with US taxation when it comes to your investments is making sure that all your financial accounts are properly certified. The W-8BN is a form that all of you should be very familiar with, whether you're opening a bank account or a brokerage account, even if you have insurance products that are based in the US. You need to make sure that you complete and properly submit a W-8BN when you first open those accounts and on a regular basis when the W-8 expire. It does expire after at most 3 years, so it has to be kept up to date. The W-8BN is simply a form that financial institutions need to receive from you to accept you as a non-resident, to certify that you are a non-resident for US tax purposes. And there are some particularities about completing this form when you are a G4 visa holder. This form will ask you for your legal place of residence. Your legal place of residence is the US. Your home in the US is where you live, and that is your legal address. The form will also ask you for your US Social Security number, and most of you will have one, so that is part of the information you need to provide in the form. And the form will also ask you if you are eligible for benefits under a tax treaty, if you are a tax resident somewhere else. As I discussed earlier, you're probably not a tax resident somewhere else. So this is something that is typically left blank in a W-8. Having said that, these particular, your circumstances are very unique, and for many financial institutions, of course, not for the IDB Global Credit Union, but for many other financial institutions out there, your W-8BN might be a little bit complicated or difficult to process. It's not normal for somebody to submit a W-8BN with a US address and a Social Security and to not claim any tax residency benefits. So this may create some difficulties in understanding your circumstances. That doesn't mean that you shouldn't use the form. It doesn't mean that you should accept to be treated as a tax resident. It just means that other financial institutions may need documentation, explanation, copy of your visas, copy of your passports, proof of the fact that you live in the US in order to properly open your accounts. It also means that many financial institutions out in the US simply will not accept you. It is normal for many banks in the US and many financial institutions to have policies which not allow them to work with non-residents. So with that, let's move on to real estate, which Dale will help us cover.
Thank you, Jose. Next slide, please. We need to move a little bit fast because we have so many questions to answer. I think we're in the 30s, Jose. But anyway, great. So let's talk about real estate for a moment. So one of the really great benefits of having purchased a home in the United States is what's called exclusion of gain from the sale of a principal residence. Now, you can exclude the gain from the sale of the principal residence up to $250,000 per joint account owner, joint property owner. So that means that if two of you own the property, you can exclude up to $500,000 of gain from the sale of the principal residence. And that would include US citizens, green card holders, and G4 visa holders. So I want to encourage you to make sure that you understand this rule, because when you're thinking about what assets that you have and the tax on those assets, most of you won't have to pay tax when you sell your principal residence. The only real rule that you have to take into consideration is that you have to own and live in the property as your principal residence at least 2 years out of the previous 5 years prior to the sale. So you look at the sales date, you count back 5 years, and if you've lived in that home as your principal residence for at least 2 of those previous 5 years, then you will meet the exclusion of gain from the sale of a principal residence, and you'll be able to exclude either $250,000 or up to $500,000. Next slide, please. Now let's switch about and talk about U.S. rental property. Jose was mentioning effectively connected income and non-effectively connected income. Well, what's really important about this is the U.S. tax law. If you're a non-resident, such as you G4 visa holders, and you own a U.S. rental property, in order for it to be considered effectively connected income, and then therefore you would be taxed if it's effectively connected income on the net after you take into account expenses. You can get it to be effectively connected income, but you absolutely must make what's called the net election. It's a simple election that you make on your first income tax return where you're renting out a property. And it simply says that you ask the government to be able to deduct the expenses related to that property. And that would be all expenses related to that property, including mortgage interest, property taxes, management fees, etc. So you want to make sure that you make that net election. Otherwise, if you don't make the net election, you could be taxed at a flat 30% as non-effectively connected income and be taxed at a flat 30% on the gross rents received from that property. So you don't want that to happen to you. Next slide, please. And finally, what the U.S. government, they don't necessarily trust U.S. citizens having foreign accounts, and they don't trust non-residents when they sell their U.S. real estate, because most non-residents having U.S. real estate live outside the country, not in the country. So what happens is there's a law called the Foreign Investment in Real Property Tax Act, FIRPTA for short, F-I-R-P-T-A. And what this requires is any non-resident, whether that's a non-resident living outside the U.S. or a G4 visa holder, such as yourself living in the United States, to withhold 10 or 15% of the gross sales price from the sale of any U.S. real estate. That would include a home that you own here or a rental property that you own. So you have to be prepared when you go to the settlement table to have a 10 or 15% withholding withheld, and then it should be your job to get. And remember, this is just a withholding tax. This is not a final tax liability. So then it's your job to get the withholding tax back by either filing a Form 8288B, and you can Google that because we don't have enough time to go through it today. You can either get that refund by filing the 8288B or a tax return, which of course, in your case, being G4 non-residents, would be a 1040 non-resident tax return, a 1040 NR. So my tip to you folks is that whenever you're selling U.S. real estate, because of this FIRPTA issue, you'll want to make sure that you find a settlement agent that's going to handle the transaction that has experience with FIRPTA. I've never known a client not to get their refund. However, I have known paperwork to be mismanaged and inappropriately applied, and because the settlement agent didn't have any experience, and therefore that could result in a very lengthy wait for your refund claim. Next slide, please. And finally, we'll talk about common mistakes that are made on the 1040 non-resident tax return. So if you're a person who's single, then would be your status, of course, would be single. But if you're married and you have to file, of course, 1040 NR, 1040 non-resident tax returns can only be filed individual by individual. You cannot file a joint 1040 non-resident tax return. So if you have a filing requirement, it's going to be your own personal 1040 non-resident tax return. And if you're single, then you file single. And if you're married, then you file married filing separately. Now, if you're a G4 married to a G4 dependent, then you automatically and would always be the case that you'll be a non-resident of the U.S. And therefore, if you're a G4 dependent, you must file a 1040 non-resident tax return, not a 1040 if you have employment authorization and you're working for a private employer in the U.S. So if you're a G4 dependent and you file a 1040 NR, when you go for reauthorization of your employment, you'll be denied that by the Immigration Service because they'll find out, because they'll look at your 1040 that will be incorrectly filed and make you file an amended return to file instead a 1040 non-resident tax return. And we find many times, as Jose was talking to you about capital gains taxation, the capital gains taxation of a G4 non-resident is going to be worldwide capital gains from the sale of securities. So we find many times that that's not really understood. And so if you owe a capital gains tax, you'll have to pay a 30% capital gains tax, whether your brokerage firm is located in the US or outside of the US. And finally, as I mentioned before, with regard to real estate, it's very important if you decide to rent out a US rental property that you make the net election in order to take advantage of being able to deduct all those ordinary and necessary expenses related to the real estate property. Next slide, please. Okay, so now we get to go into the question and answer period. Jose? Oh, you're muted.
Thank you, Dale. Thank you, everybody, for your questions. We are going to answer as many as we can, and there's some very good questions in here. Dale, the first one is, I work remotely as an independent contractor. Is it correct for me to file the W-8BEN?
Yes, you would file the W-8BEN as an independent contractor for a company. I'm just looking at, and you would file a 1040 NR tax return. Mm-hmm. What other is that question asking? So what's important to know, if you're a consultant for a company, independent contractor, and you're working in the United States as a G4 dependent, that means that your income is taxable because it's where you actually physically perform the work that makes it U.S. source income and becomes subject to U.S. tax. But what should be noted here is that if you are an independent contractor, a self-employed individual, that there would be no Social Security tax on your compensation income that you're earning as an independent contractor. That's important to note. So don't assess yourself self-employment tax if you're a non-resident working in the United States.
And I think that's part of the next question, right, Dale? This is similar individual contractor for an EU-based firm. He's asking about all these specific forms, including the self-employment form.
Yes. So you file those. You wouldn't file this form SE because that would be self-employment form, and you're not subject to self-employment tax. But in addition, you are eligible for a number of different, of course, deductions as well. And Jose, you want to mention the fact that about the independent contractor filing for some pension?
Right. So you're, as an independent contractor, your income, which is subject to taxes in the U.S., also gives you the right to make contributions to your own retirement account. You can set up a retirement account for yourself, a retirement plan for yourself as an independent contractor, and make contributions as long as you comply with the rules regarding the limits. And of course, that can have significant investing advantages, particularly in the form of deferring taxation for many, many years. And the next question is related to that, Dale. The answer to that question is that your income, your salary from the IDB, because it's tax exempt, it is not considered U.S. earned income for tax purposes. And therefore, no, if your only income is the income from the IDB, then you're not eligible to make any contributions to an IRA account, Roth IRA or traditional IRA. Next question is, can I deduct expenses from a home that I bought in DC in 2025?
I suppose that would depend on whether or not, so if it's just a home that you live in, there is no tax deductions related to the home that you live in. So if you were a U.S. tax resident, then you might be able to take advantage of what are called itemized deductions and deduct a home mortgage interest, property taxes, et cetera. But as a non-resident, those are not available to you. Mm-hmm.
We've covered a lot of issues related to taxation of dependent G4 visa holders, which is the next question. We've also talked a lot about investing and capital gains. We'll answer some more questions on those topics. So let's move on to the next question, Dale. If a G4 visa holder becomes a resident, do they need to report FBAR and FATCA?
Yes. So if you either get a green card or no longer work for the IDB and you are eligible to stay in the United States and become a resident of the U.S., then you would have obligations under informational reporting, which can include the FBAR and FATCA.
And the next question is about dividends. Dividends under $100 on my U.S. tax, do I need to report them on my U.S. tax return? So when it comes to dividends, if you're a non-resident, of course, I'm assuming this person is a G4 non-resident, dividends are taxable depending on the source. Dividends from U.S. sources, U.S. corporations are taxable in the U.S. Dividends from foreign corporations are not taxable. Typically, we talked about the W-8BN and setting your accounts up correctly. If that is the case, typically any dividends that you earn are subject to withholding. So your taxes are paid at the source by the financial institution that holds your investments. And in that case, you don't have to file a tax return. But if that's not the case, if your dividends were not subject to withholding, then yes, regardless of the amount, you need to file a U.S. tax return and report any U.S. source dividends and pay taxes accordingly. Next question is about capital gains. G4 visa holder who already knows that capital gain is taxable. What is the correct process to report and pay taxes to the IRS? So, of course, as a non-resident, you would have to file a 1040 NR. That's the form you file at the end of every year. And you would simply include in this form your capital gains and calculate the corresponding tax, usually, as we said, 30%.
And that would be on Schedule NEC, non-effectively connected income.
Thank you, yes. Is this something that individuals can reasonably handle using standard tax software? There is tax software that can help non-residents with this. You may have heard of TurboTax, of course, very popular software solution for filing taxes. You can avoid TurboTax because they won't help you prepare non-resident tax returns. But you might want to look into two other solutions, TaxAct, TAXACT, and SprintTax, SPRINTAX. We must file taxes as a G4 visa holder, IDB employee. What happens if we had labor income from other non-exempt sources? Should we file both together?
I suppose they're talking about labor and for services for the spouse.
Seems to be related to a spouse, yes.
Yes, and so as we talked about before, you cannot file jointly with your spouse if you're a G4 married to a G4 dependent. So that G4 dependent would have to file his or her own 1040 NR tax return.
Right, so separate tax returns, and it would have no impact on your IDB wages whatsoever.
Right.
For dependents of a G4 visa, are they exempt from FICA taxes as long as they maintain G4 status?
No. So we talked about the fact that the self-employment income was not subject to self-employment tax, which is actually a Social Security tax if you're an independent contractor. But if you are an employee that's a G4 dependent working in the United States, you have obligations under the Social Security system to pay what's called FICA taxes. That's the same as Social Security taxes. And so you have to pay FICA taxes if you're an employee, but you don't have to pay self-employment taxes, which are the same as FICA taxes as a non-resident independent contractor.
Yes to the next question. Interest income from the IDB credit union or any other bank product is tax exempt. Non-residents do not owe any taxes on interest income, regardless of the financial institution where you're earning it. If our investment platform provides us with tax forms, is it enough to use those to report our capital gains? So when you file a tax return, a non-resident tax return, you don't need to provide any evidence of your capital gains. You simply go through your financial institution forms, determine your cost basis, determine the proceeds from your transactions, and calculate the capital gain and report that amount in the tax return. Evidence would be required if you were ever audited by the IRS. And in that case, you would want to keep the documents that you use to calculate your capital gains, typically the year-end forms that you receive from your financial institution. I have an account with IDB Global. I used to be a consultant for IDB in DC with a G4 visa. After my 3-year period, I left DC and I did not use my account much. Last December, I got a new job as staff. I'm receiving my income. I want to know if I need to declare taxes. So it seems like this person it was a non-resident and continues to be a non-resident. And in that case, your account at IDB Credit Union would simply pay you interest. And as we said, is non-taxable, so it doesn't require you to file a tax return. This next question is in Spanish. I was in the US. I was in the US 172 days. I changed my status 2 years ago. Do I need to file Form 8843 along with 1040 NR?
The 8843 is a form that you file to exempt your days in the U.S., but it only applies to students, J1 visa holders, and others. As a government-related individual, it's called, working for an international organization, you're exempt from having to file the 8843 to exempt your days. They're automatically exempted from counting under the substantial presence test.
And that's kind of the next question as well. Again, your days of presence in the US as a full-time employee of an international organization, it doesn't matter, the G4 is not really relevant in that definition. If you're full-time employed for an international organization, your days of presence simply do not count for purposes of the substantial presence test. Neither do the days of presence of your dependents. If a G4 visa holder who is married to a US citizen chooses to file a joint tax return, does their salary become subject to US income tax? No, as we said, your salary remains tax exempt even if you make the 6013G election. How does investment income from other countries get taxed? So again, if you're a non-resident, your dividends, interest, investment income outside of the US is generally not relevant for US tax purposes, is not subject to income taxes. The only exception there would be capital gains from investments in securities, stocks, bonds, mutual funds. So if you have a brokerage account outside of the US and you trade in stocks, bonds, or mutual funds, and you have capital gains during a calendar year, that is something you need to report in the US and pay taxes accordingly if you spend more than 183 days. Otherwise, there would be nothing for you to declare.
And Jose, we know that some countries actually tax capital gains abroad too. So we have the case of double taxation in some instances. What do most clients do when that occurs?
Yes, absolutely. Double taxation is a risk that we mentioned during the presentation, and many G4s coming to the US for extended periods of time would want to consider carefully at their investments abroad if they are subject to double taxation, and perhaps think about bringing that money over time back to the US. Would income received from foreign government, foreign country's embassy in the US, be considered US source income and subject to taxes for a G4 dependent?
That's a very difficult question. So I'm not an A visa holder. That would be an employee of an embassy. Typically will have an A or an A2 visa holder. Would have an A or A2 visa. But I don't know what the answer is if you're a G4 dependent working for an embassy. You might want to contact Embassy Tax Services. That's one reference that I have for you. If
a G4 visa holder who is married to, question, maybe I repeated it. I'm a G4 employee at the IMF. My husband, also on a G4 visa, works as a teacher and pays taxes, files separately. Can he claim our daughter as a dependent for tax purposes?
So the only people that can claim dependent is a person that is either a tax resident of Mexico, Canada, or South Korea. So it's very likely that even if you were in Mexico or Canada or South Korea, that when you came here to work on a full-time basis with an international organization, or your spouse just came to work here, then it's very likely that you lost tax residency in Mexico, Canada, or South Korea. So almost all clients that we have are not eligible to claim dependents on their 1040 NR tax return.
Does a G4 spouse working for a firm get higher or lower tax rates than a typical tax resident employee? So technically speaking, the tax rates are the same, but a G4 filing as a non-resident, a G4 spouse, has less deductions and cannot file jointly, typically files separately. So normally the G4 would pay more taxes than a US person doing the same work, earning the same salary. So it's a matter of deductions and filing jointly versus filing separate.
But as I said before, if you're a G4 dependent, of course, you're married to a G4, and then there's nothing you can do about your non-resident status. You can't make yourself into a tax resident.
As a G4 visa holder, I bought a house in 2004. Am I exempt of taxes up to $250,000 of capital gains? Absolutely. The exemption of capital gains on the sale of your primary residence is applicable to G4 visa holders. Are dividends for high yield savings account taxable? Technically speaking, a high yield savings account does not pay dividends, it pays interest. There's a distinction between dividends and interest for tax purposes, and interest is non-taxable. If I have a stock of a US, yes, Dale, go ahead.
I was just going to say that many of our clients who have high yield savings accounts are set up incorrectly in the system as US persons, aren't they?
Yes, we talked about the W-8BN and making sure that your accounts are set up correctly. If that's not the case, then it's important that you work with your financial institution, if it's not the IDB credit union, to set up your accounts properly so that you don't have reporting issues vis-a-vis the IRS. Even though interest is non-taxable, if you're not set up correctly, the interest that you earn will be reported to the IRS and may possibly generate notices from the IRS, which you would want to avoid as much as possible. If I have a stock of a US company granted to me as part of my compensation, is it considered income or capital?
This really all depends on the stock plan that you have. If you are immediately vested in the stock that you're given as part of your compensation, then that would be considered compensation income. But if you're given, let's say, a stock option, and down the line you're able to exercise it, even in that case, if it's a qualified stock option plan, then you would be taxable at the time that you exercise the stock option as compensation income. So it really depends on the type of stock plan that you have.
If I earn interest from a high savings, high yield account, no taxes, that's all interest. Why is the bank, this is a good question, why is the bank withholding a portion of it? So, of course, we said that interest, such as what you earn in a high yield savings account, is non-taxable. So as long as everything is set up correctly with your bank, there is no reason for them to withhold any taxes. If they are withholding taxes on interest payments, that's a clear sign that something is not set up correctly with your account. That typically happens when they can't confirm your status and they automatically subject you to backup withholding. If they're not clear about your status, or if there's inconsistencies in your information, they will subject you to backup withholding, and that is typically 24% of any proceeds generated from an account. That doesn't mean you owe those taxes. So it would mean that in order to recover them, you would have to file a tax return and ask the IRS to refund you those taxes, that withholding. We talked about interest. CDs at the credit union are generate interest, which is tax exempt. At Bank of America, it's been so hard for them to understand that I need a W-8BN. And most recently, they said they don't need it. Is that correct? No, of course not. As we said, you understand now that you're a non-resident, and that does require W-8BN for the financial institution to properly certify your accounts. I said that it may be difficult in some cases for a financial institution to understand this because of your circumstances. What that means is that your account wouldn't be set up correctly, and it means that interest that you earned would be reported to the IRS. It doesn't make that interest taxable. You don't owe taxes. There's nothing you can do about them reporting it to the IRS. It simply means that, number one, you've certified yourself to be a tax resident, which is incorrect. And number two, down the road, depending on the amounts involved, you could get notices from the IRS because they're expecting you to pay taxes on that. When I left the IDB and DC, my G4 visa expired. I put my savings into maturity shares. Are they taxable? So if your visa expired, your G4 visa expired, and you're simply not living in the US anymore, you are a non-resident regardless. And all of the same rules that we have discussed apply to you, whether you have that G4 visa or not. If you're a non-resident, bank interest, maturity shares from a bank are not subject to taxes.
And of course, if you're living outside the United States, there is one rule that no longer applies to you, and that would be you're no longer subject to capital gains from the sale of securities.
Absolutely. Bank of America insisted that I put my address abroad for purposes of the W-8BN probably, and that's incorrect. Technically, you're lying about your legal place of residence, which is here in the US. You should try to correct that and help them understand that you're still a non-resident, even though you live here.
It could be that their policies and procedures simply don't line up with any non-resident living in the US. And so therefore you may not get satisfaction and be able to be set up correctly. Absolutely. You may have to go to another institution.
Absolutely. I lost my place. I don't think we'll get to the end of all these questions in the time that we have. We only have 5 minutes more, Marilyn. I don't know if you want to step in or we should continue.
Yes, I am back on. Those are a lot of great questions, so thank you. And I do want to emphasize that based off of these webinars and based off of who the credit union is, we do understand the roadmap you go through. We do understand your situations. We do understand everything and the nuances that help you make you successful. So please make sure you come visit us at the credit union, open the accounts, and you know that we have these amazing speakers that are always here for you as well. So thank you, everyone. I think it's just a testament to how we know our membership and what they need to succeed. So tomorrow we have another webinar. Make sure you sign up for that. Make sure that you make any appointments that you need from a lending perspective or from a deposit perspective. You can go on the website, make that appointment. Our lending team is also here to do a credit report for you, free credit report. So make sure that you do that as well. And always come and visit us. We are here. We love to see you, and we love to meet you in person, even just to have a. So sign up for the webinar tomorrow. Look at our products and services, and we wish everybody well. Have a wonderful day, and we look forward to talking to you soon. Ciao.
Thank you, everybody.